Ladies and gentlemen, good day and welcome to the Q2 FY23 results conference call of EPL Limited, hosted by Systematix Institutional Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pratik Tholiya from Systematix Institutional Equities. Thank you, and over to you, sir.
Thank you, Lizelle. On behalf of Systematix Institutional Equities, I would like to welcome all the participants who have logged into this conference call of EPL to discuss the second quarter and H1 FY23 earnings. From the management team, we have Mr. Anand Kripalu, MD and CEO, Mr. M.R. Ramaswamy, COO, Mr. Amit Jain, CFO, Mr. Suresh Savaria, SVP Legal and Company Secretary, and Mr. Deepak Ganju, President, AMESA Region. At the outset, I would like to thank the management for giving us the opportunity to host this conference call. I would now like to request Anand sir to kindly begin the proceedings by giving his opening remarks. Thank you, and over to you, sir.
Thank you very much, Pratik, and hello everybody, and welcome to this earnings call. When you look at the previous quarter under review, we had a persistent inflationary environment impacting energy and wages, particularly in the Western world, coupled with higher commodity consumption costs. And these have affected many businesses globally. In addition to this, the quarter saw unprecedented currency devaluations versus the US dollar. While the impact of COVID in China is reducing, the zero tolerance policy is still hurting day-to-day business. Despite all of these environmental challenges, I am pleased that we delivered double-digit revenue growth at constant currency with significant sequential EBITDA margin improvement. At prevailing currency rates, EPL grew by 9% with strong growth across AMESA at 16.9%, Americas at 19.7%, and Europe at 8.9%. EAP delivered a growth of 1.5% despite the COVID-related challenges. During the quarter, the category that we're now christening as personal care and beyond, which includes BNC and pharma, etc., saw strong growth of 17.7%. Oral care grew by 6.7%, predominantly affected by EAP. Over H1, EPL's share of revenue for personal care and beyond improved to 47.8%, which is 220 basis points better than last year. Excluding the impact of setup costs in Brazil, EBITDA margin for the quarter stood at 16.3%, an improvement of 119 basis points, and a growth of 22.9% sequentially. Critically, our efforts on pricing and cost savings programs have started to bear fruit. And despite continued rising costs and currency devaluation, we delivered sequentially improved margin. In fact, we are pleased to report broad-based sequential improvement in absolute EBITDA across all regions. Our net profit saw sequential growth of 39.7% at INR 482 million. Considering the widespread external challenges, we are pleased with this set of numbers. EBITDA, including setup costs in Brazil, which are really for long-term growth, stood at 16.1% and PAT stood at 462 million INR. Sticking with the subject of Brazil, I am pleased to share that the project is very much on track. Construction activity is in full swing and recruitment activity is very much in progress. As committed earlier, we will commence commercial production by the end of this fiscal. What's exciting is that several local and global players are evincing interest in our Brazil supply base. During the quarter, we have also made good progress on winning new business and driving sustainability. As far as innovations and business wins is concerned, EPL continues to lead the industry in innovation and design disruption with offerings like the NeoScene, which minimizes the visual impact of the side scene. We are pleased to have received the first commercial order for this technology. We have also developed the Dia 16 spin breaking tube, which is a special tamper-evident design. Our focus remains on growing the laminated tube market by converting aluminum tubes and rigids. There are some more of these wins this quarter. We have recently been awarded for our anti-counterfeit tube and Platina eco-friendly tube. Moving on to sustainability, sustainability remains our key focus area, be it product, process, or people sustainability. We are pleased to announce that two variants of Platina, Platina Pro Me and Platina Pro Vision, have been recognized by APR, which is the Association of Plastic Recyclers in the USA. Platina Pro Me provides a metallic look to an eco-friendly tube, while Platina Pro Vision is a transparent tube. Both these innovations provide aesthetically appealing tubes which are fully recyclable. In addition to 5 oral brands globally, 2 additional brands in personal care and beyond have embraced the Platina solution. Our target is to double Platina volumes in FY23, and I am pleased to report that we are very much on track. We have persisted with our CSR program to deliver benches made with recycled plastic to schools, to accelerate the skill development program, and to invest in enhancing the quality of life for the communities who live around our plants. Finally, but importantly, we have launched a company-wide effort to go for gold on EcoVadis. Overall, EPL will continue to drive sustainability in line with our long-term ambition of becoming the most sustainable packaging company in the world. We believe this will be our sustainable source of competitive advantage, laying the foundation for long-term profitable growth. And finally, looking ahead. In recent quarters, we have seen exceptional and unprecedented headwinds. And every time when we felt that the worst is behind, new challenges have emerged. These include COVID, volatile and inflating raw material prices, high energy costs exacerbated by the Ukraine conflict, wages, and freight. General unprecedented inflation in the Western world are devaluing currencies across the board, and these present new emerging challenges. Clearly, volatility and unpredictability is the new norm, and we need to stay even more vigilant and agile in this new world. The good news is that we know how to manage these situations as demonstrated in the last quarter. we will continue to keep one foot on the accelerator of growth by hunting down new business while keeping the other foot firmly on the brake of cost. Some of the interventions for the next quarter include continuing the hunt for new business, persisting with price increases specifically linked to inflation due to energy and minimum wage, sustaining the momentum on our margin improvement plan, continuing the effort on driving sustainability, and managing raw material costs that have been adversely impacted by spiraling devaluation. Considering all these factors, we remain cautiously optimistic about the future and are committed to our stated objective of delivering sustained, profitable, double-digit growth with margin recovery. Thank you. And with that, we will now open this up for questions.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, good evening, sir. Thanks for taking my question. Couple of them. First, on this currency movement, can you help us understand how exactly it hurts us and what are the geographies which are negatively as well as positively impacted from the currency? Particularly in the backdrop that a lot of raw material is manufactured in India and China. And again, it is sold in Europe and other geographies except America, where I think the currency depreciation should not have impacted. It's only US geography, but I would like to hear the complete currency movement and how it impacts us in each of the business segments. Thank you.
Okay, I'm going to pass that on to Amit Jain to respond to that, and if there's anything else, then I'll add to it. Amit, you want to take the point on currency?
Yeah. So Sanjay, the currency movement, actually when the currency devalues against dollar, so you are aware that we are buying the polymers from various global suppliers. So that impacts at the first level in the India and China, where we are manufacturing the laminate structure, which is raw material, and then it's an impact which goes in all countries, because as a base cost, which is landed cost, has increased because of this currency movement. So because of this devaluation, the landed cost of material goes up. So that's how it impacts in each of the countries wherever we are buying the raw material from India, China, and the polymers in India and China.
Basically, you're telling there is no benefit, because I think we also sell to US, which should have positively. We buy at least not positive; it should be neutral. But no, I'm still not very clear, Amit, on the currency impact, because historically we have not seen currency hurting us. If I take a long term view of this business, say if I look at last 5, 6, 7 years, where currencies against the dollar have been continuously devaluating, but that has never shown up in the margin. Why this time that is different?
So, Sanjay, there are two things. One is the currency movement this year, and particularly if you see last 6 months, it is enormous. It's not a normal devaluation which we see on a longer term. But if you see for last 6 months, all the currencies against dollars have moved substantially depreciation. So that is one which is impacting. And then there are two things. One is on the cost side, and then if there are pass-throughs also for the contracted customers, where landed price is also a function of landed cost, the revenue part. So the major reason this year is basically the substantial movement in the currency. And when you compare it with historically, those movements are not that substantial.
Okay,
So if I can just add to what Amit is saying, see, a large part of our polymers are bought in dollars, huh? Just so that you're clear. Those polymers come into India and China and are converted to laminate. So the input costs that go into India and China are a large part of it are dollar denominated.
No,
Now,
that's what I was
part of that goes to America, right? The rest of it goes to Europe, where the euro and the Polish zloty have devalued, comes into India for the rupee, and goes into China itself, where there is a small devaluation of the Chinese currency.
No, that's the whole point, because Europe has depreciated, India has depreciated. It is just transactional entry. There should not be any major impact beyond the polymer conversion. And polymer, again, I thought because we buy it in the dollar, my perception was that a lot of it is a dollar billing. Otherwise, this problem creates a significant risk within the system where the buying currency and the selling currency is significantly different.
So Sanjesh, if you see from India and China perspective, India, because we are buying the polymers in dollars, we are net importer in India, and these polymer purchases definitely impacts the landed cost of the polymer.
Agree.
Yeah.
No, but just so that we are clear,
aren't they linked? I thought this is linked. So basically, you're telling that you always remain that if currency depreciates, the hit is on the EPL or it gets passed on to the customer. The perception was that it is well known and that conversion generally gets passed on. It's just a timing issue, or you think this is a structural issue where we will have to face a impact on the margin because of the currency?
It's a timing issue only. For the contracted customer, when we take the material prices, it is a landed price, which includes the foreign exchange also. So it's only a timing difference.
It's just a transactional issue, right? And next or a quarter beyond that, that currency should not hit us incrementally, correct? We should normalize to the earlier level. Is that assumption right?
Yeah, that's right, Sanjesh. But then when it gets into the timing difference, there is always be a lag, correct, on the pass-throughs and other things. So that impacts.
No, but the thing is that we have one side polymer prices falling in the absolute dollar term, and then there is a currency. I thought in the rupee terms it has not, because I tracked a lot of polymers and I have seen in rupee term they have actually fallen despite currency being weaker. So that makes me even more that the polymer prices drop is much higher than the currency. Why this should happen, right? We have taken a price hike for the higher polymer prices. Now I understand there is a currency mismatch, but I'm telling we got a much bigger offset in terms of polymer prices itself falling. It is just we were sitting on a high cost inventory and hence this is happening. No, I'm not able to reconcile because the results of other polymer companies and the reasoning is very different.
But this currency movement which has happened this quarter for the current which is going on, the depreciation of dollar, INR and dollar is huge. And it's largely offsetting the softening of the prices.
Okay, let me take it offline. I will send you the prices. Probably we can have a more discussion. But my second question is more on the freight side. I think I can understand power cost in Europe is elevated, but falling freight costs now should be an incremental margin driver in the quarters coming by. Will that be a fair assumption?
Yes, Sanjay. Freight costs are coming down. This will help compared to the last 3 quarters. Prices are coming down. Yeah. Freight is coming down.
So that will help us improving the EBITDA margin in the quarters coming by, right?
Yes.
Great. And on the EAP side, Anand sir, if you can give us more color in terms of how the market is shaping up. Sequentially, we had a phenomenal growth, 12%, but we are still below the peaks what we have done in EAP. How should one see the EAP shaping up from here? with COVID restrictions slightly coming down, at least it is moving on the easing side.
So, yeah, absolutely. I think the worst is behind us, but all the restrictions have not gone. Okay. So what has happened is, right, in Q1, we were kind of minus 6% revenue in EAP. Right now, we are at plus 1.5%. Okay. But we are not back to where we need to be. And I think that's where some of the restrictions that are in the short term at least hurting business, those restrictions are still there, right? We were expecting some big announcement post the Communist Party elections. They have not happened, and yet, so therefore the zero tolerance policy continues. I think the silver lining for us in EAP is, and clearly the best is to come, right, and the worst is behind us. I think the silver lining is that despite a significant impact on top line, right, the overall P&L is very, very robust. And the confidence that certainly I take away is that as things start loosening up in terms of the restrictions, right, I think we will get huge positive leverage as far as EAP is concerned. Now, the question is, longer term, EAP remains a very, very big domestic market, probably the largest domestic market in the world, right? And that's what we are all aiming to serve. Some of the geopolitical issues, right, and not just for us, but even companies like Apple and Tesla and everybody else, some of those geopolitical issues could impact EAP, particularly China, as a global sourcing hub for multinationals, right? Everyone is trying to build a plan B against the sole China as a supply base, right? So some business is going to shift out of China. But, you know, our business, I think, is well set up to serve the local market. We have huge headroom to gain share and grow our business. So I remain, you know, I would say, you know, positive about, you know, how we've managed the crisis in China. The fact that things will only improve, right, as each subsequent month comes, and that will, you know, help the business. So that's how I see it.
No, that's fair. That's fair. My last question is on the pharmaceutical side. That business looks like still not growing, while we remain quite optimistic on aluminum tube shifting to laminate. But in terms of performance, if I look at pharmaceutical, it has really not delivered the anticipated results. The growth in beauty and cosmetics are fantastic, but that's not replicating in the pharmaceutical side. Any one-off or any challenges that we are facing in the pharmaceutical side of the tube?
So I will say this, that pharma is doing really well in MSR, right? But we have a lot of work to do to crack bigger unlocks, right, in the other regions as far as pharmaceuticals is concerned, where our business is relatively small.
No, I'm telling that even within AMESA, we are not growing at industry rate. The revenue is flattish YOY.
I don't know if we shared the numbers there. Deepak, you are there on the line.
We do share that on the presentation.
Have we shared pharma growth numbers for AMESA?
No, you share the mixed number. I derived the growth number.
Sanjay, there are a lot of conversions in India when pharma is taking place. Okay. We are actually doing really well in pharma. Yeah. And Sanjay, if you see half yearly, pharma category has grown for us.
Okay.
Yeah.
Fine, sir. Fine. That's it from my side. Thank you for answering all the questions and best of luck.
Yeah. And do pick up this issue of FX offline, because actually it's a very simple and clear issue, and maybe we've not given you enough clarity here, right? And the only point I want to leave is that FX challenges that are there are all built into contractual customers, so it will never be out of pocket apart from the phase lag that Amit spoke about. So it is not as if it's going to be out of pocket if there are significant currency movements.
Point noted, sir. I will take this.
All right.
Probably discuss it.
Okay, thank you.
Thank you. The next question is on the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, sir, and thanks for taking my question. Just following up on the previous question. So what I notice is that most of the RM prices, aluminum, HDPE, etc., they have been continuously declining in the past 6 months, and there has been a continuous effort towards price hikes from our end, and crude prices also been range bound. So apart from currency, just trying to understand reasons for sequential decline in margins. MSI, America, Europe, all three regions I see a sequential decline. Now Europe, I understand there have been multiple issues in terms of energy, etc. But what exactly are the reasons in the other two geographies? If is it mix? Is it something apart from currency that we are missing? Because over to you on this, sir.
So I think, and I'll give a few lines there, and then the team in the boardroom can elaborate on it. I just want you to recognize that our consumption costs of inputs, right, which is the entire cocktail of polymers, aluminum, all that put together, our consumption costs actually peaked in Q2, right? And that's based on the inventory that we carry. Right. So I just want to clarify that point that, consumption costs will come down, right? Part of it is going to be eaten up by the FX movements that we've discussed as a response to the previous question. But in this quarter, right, consumption costs actually peaked because this is what we consumed here between July and September. It is what was bought 3 months prior, right? 3, 4, 5 months prior. And that was when we actually hit the peak of input costs. Okay, but over to Ram, Amit to comment any more on that.
Yeah, no, you're right, Anand. Then this quarter was a peak quarter for the consumption. And Samir, for your question on the sequential, I think from the sequential angle, all the regions have grown in the EBITDA absolute and EBIT absolute. So I'm not sure that on the sequential number why you are seeing that.
Yeah, Amit, I was mentioning about the margin, not the absolute amount. Second question, sir, from my side.
For margins, I think, Samir, for all the regions, and AMESA is a small dip, but on the other regions, even margins have improved compared to June sequentially.
Yeah, I mean, fair. On the other side, sir, so what we have seen is historically we have delivered 18 to 20% of EBITDA margin, even in times which were challenging. Now I know the reasons, and we have seen a dip in margin to around 15-16%. What is our thought process here? So if you are let's say getting a double-digit growth, are we okay with this kind of a margin, or the strategy is clear that we have to plow back back to our hygiene margin of around 18-20%, even delivering with this double-digit growth?
So I want to make this very clear, okay? Now, and I'm not going to get to 18 or 20, right? But our absolute aim is to restore the profitability of this business. The profitability, right, save for any translation losses that have happened because of pricing, right? Because of the mathematics of the numerator going up and the denominator going up as well by the same amount, okay? So that is our aim, right? And, and we're not going to give quarterly guidance and so on and so forth, but our strategy and all the efforts that we are putting in, right, is absolutely aiming for us to get there. The concern is, and that's as much of a concern for us, is that every time you put a complete plan in place and you feel you are, that goal is around the corner, another big funny happens, like this quarter was, FX, okay? It was just a big funny that happened, right? And it ate up. And yes, it is. There's a phase lag thing, but in this quarter it did eat up, right? A sizable amount of margin. Okay, so I think fundamentally the way you guys should look at this is to say that, and I'm not going back to the denominator number, but sequentially, right, this business has moved forward, right? The last quarter, Q1, was the worst margin we had, right, in many, many years at 15.1, when I think we were in the midst of that perfect storm. Okay. Now, certain levers have started improving, while certain levers have continued to pull us back. But the good news is that more things have taken us forward than have pulled us back. Right? And therefore, you've got to believe that some of the interventions have started bearing fruit. Now, I've called out the kinds of the scenarios that we're in and the kinds of things that we are doing. Okay, and at some point in time, uncertainties and unknowns are going to disappear. Right? I mean, there are only so many variables in a P&L finally in the environment, and then our absolute aim, right? Now, I don't think this management team is going to rest till we get back to the levels of profitability that we enjoyed as a business, right? Save for any percentage losses due to translation. So I just want to be very, very clear about that.
Sir, just a clarification. When you say profitability, do you look at the margin or do you look at the EBITDA per tube kind of a metric?
No, I'm going to look at, EBITDA per tube kind of metric for a moment, right? Because like I said, percentage has a translation loss associated with it.
Great, sir. I'll get back in the queue for any follow-ups. Thank you. Thanks a lot, and all the best for future.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Janish Karia from Antique Stock Broking. Please go ahead.
Thank you for the opportunity. The first question is with regards to the Brazil opportunity. So what kind of, so last quarter, if I'm not wrong, we had announced some amount of investments, and so what will be the full year investment amount in that? What is the market size, the opportunity that we are eyeing, and some color on what revenue potential that we see from this region?
So, I'll just tell you that our interest in the Brazil opportunity actually has gone up in terms of excitement. Because ever since we made the announcement and started the investment, right, and our plant is kind of, at least the shell of the plant is almost ready now, and equipment is on the high seas, right? The amount of queries and interest that we have seen from multiple other local and global players, right, is very, very encouraging. Okay, so we remain very excited. If anything, our excitement levels have improved ever since we made our announcement. Now, we are not in a position, right, because I don't think it is appropriate at this point in time to give you a sense of what the potential is for the revenue contribution that Brazil is going to give. Right? I'm conscious that you guys want to know something, and we will do it at the right time. Right? But I don't want to hazard, giving you something now, as this project is evolving now. Obviously, we have a business case internally, right? And the business case aims to deliver a good quality of payback in line with the nature of business that we are in. Okay? But beyond that, I don't think we would like to share at this stage, more about the revenue or margin potential that the Brazil opportunity offers. Now, Amit, what have we said earlier? Is there any more flavor that we are in a position to add on the investment that we are going to make in Brazil?
No, I think you have covered. And Janish, just to give you the comfort is that we are entering into the Brazil on the back of a contextual customer. So that's a starting point, because normally in a new geography, entering into with an anchor customer is always good. And once we are on the ground, we'll look for other customers, and we already started that exercise, and that's why Anand was saying that there are multiple customers which are showing interest on this project.
Okay, great. So for now, what I understand is that capex of 1.3 billion for FY23 is what is committed, and as and when there will be developments, we'll be knowing about it. Correct?
Yeah.
Okay. Second question is on part of other expenses, so that has gone up sequentially. So is it only primarily because of the foreign forex loss, or there's some element to it also?
See, again, in the other expenses, Janish, there are part of like packing material cost and the power and fuel also, which is going higher sequentially, and the Europe market, and even in AMESA region, there are some disruptions on the power supplies, so that is impacting the other expenses.
Okay, and so one question is on the gross margin perspective. So, correct me if I'm wrong. So, we are seeing the polymer price declining, and that
Mr. Sade, we're not able to hear you clearly.
Is it better now?
So, can you use the handset mode while speaking and on the speakerphone?
Yeah, hello, is it better now?
Much better, thank you.
Yeah, so next question is on the gross margin perspective. So, gross margin has declined on a sequential basis. So, correct me if I'm wrong. So polymer prices have declined, and the benefit of that decline has been offset by increase in the dollar rates. So is it because of that? How do we look at the gross margin contracting?
If you want to see quarter 2 specifically, the quarter 2 was the peak for material consumption, because whatever we bought earlier, that has come as a consumption in this quarter. So Q2 was at peak prices for materials.
Okay, so there will be some amount of inventory loss in the...
Definitely. Any business will keep some inventory for... So if you see Q2 is the peak on the prices, and the softening impact we will see in future. But what we are saying is that because of the currency depreciation, devaluation against dollar, those softening of the prices are getting largely affected by the exchange rate on the landed price.
Okay, if you can quantify the amount of inventory loss, a broad flavor on that also is fine.
So Janish, maybe we can take those offline, because I can't be those granular on the call.
Okay, no problem.
Yeah.
Thank you so much. That's all from me.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Samrid Rela from Value Research. Please go ahead.
Hi, sir. Just wanted to know the capex commitment that you have made for the Brazil project.
I think that we have shared in the last meeting. It is 138 crores for the Brazil project.
Okay. Thank you.
Thank you. The next question is from the line of Shalabh Agarwal from Snowball Capital. Please go ahead.
Hello.
Yeah.
Yeah, thank you for giving this opportunity, sir. So just on Brazil, without really going into the numbers, just qualitatively wanted to check, do we get preference to supply tubes to a customer to whom we may be supplying tubes in another geography? Because some of the oral care customers would be the bigger customers across geographies, I would believe.
Yeah. I mean, you may or may not get preference. Now, in this particular case, you will obviously get preference from a customer who is our anchor customer, based on whose commitment we have made the investment. Okay?
Sure.
Now, on the back of that, I said earlier that there are other players, local and global, who are evincing interest, right? And we are excited about that. So there could be other players in oral care, but also beyond oral care, right, who may join the bandwagon. I think the preference will could be because we have a good relationship, and the anchor customer is obviously because we have a good relationship with them on certain categories in other geographies in the world. Okay, because many of these companies are truly global in the way they operate. But then for some of the other customers, it could be because we are the most credible local supply base that's available in a country like Brazil compared to other players who may not have the credibility that EPL has, right? So they'll come to us. So I think it's a mix of both, really.
Sure. And so secondly, I also wanted to check, how is the customer concentration for us? Like, how big would be the the biggest customer or the top 5 customers for us? And what would be our wallet share with them? Some qualitative color if you can provide.
Ram, do you want to share a little bit about a concentration of customers?
So I think we should see it from the category perspective, and you know that the oral care is basically 4 major customers, which is having the market share globally.
Right.
So there you might see some concentration because these 4 players are taking most of the shares of the market. But if you see the personal care and beyond, which is other categories, there are a lot of customers because it's a fragmented market and different geographies will have different brands and other things. So from that angle, there is no concentration on those categories.
Okay. And so what would be our wallet share broadly with some of these the biggies in the oral care segment?
So that we can't share, but it's different for different customers. We can't share the wallet share.
Okay, but would we be the biggest for all the 4 biggest players? Or would that be a correct statement to make?
In some regions we are bigger, in some regions we may be a second. Most of them have 2 supplier policy, right? So in some regions we will be bigger, in some regions someone else will be bigger. But overall, in most of the market, we are market leaders.
Okay. And so just lastly, just wanted to check, on Albia, how big would Albia be in terms of the tubes they manufacture? Just trying to, have a sense of, where we are placed with respect to Albia. And, would their share in BNC would be higher than us?
So there are various types of business models. There's a big difference between Albia. See, we are predominantly Asia player, right? Our market is very big in India, very big in China, that large population lies, right? But their marketplace, they are larger in western part of the world because they are much earlier than us. So that's the difference. But then within the market, there are segments. In some segments that we have started gaining, even in western part of the world, that our share on the oral care is very large. But their share of beauty and cosmetics that we are working on to catch up. So that's how you need to see. In overall, globally, we are the largest.
Sure. Thank you, sir, for taking my questions, and all the very best to the entire team.
Thank you.
Thank you. The next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. So my question is regarding USA business. So can you talk about considering higher inflation, how is the demand side in USA, and we have seen the higher margin contraction comparatively and lower single-digit margin in USA business. So how is the cost scenario in USA?
So, broadly speaking, the demand scenario in the US is, I would say, still solid, right? Still strong. There are significant pressures on the cost side in the US, right? And therefore the need for inflation-related price increases, right? And some of which are still due to come in Q3, right? Which have now been approved by the customers and will come. The cost side, right, the inflation-related costs, which are largely to do with wages, right, has been very significant because, you'll speak to anybody in any industry in the U.S., they aren't able to find people to come to work, right, and you've got to pay more. and yet you have absenteeism and things like that, and then you have to end up paying overtime and so on. So earlier it was COVID related and so on, and now it's just that people don't want to come to work, and you got to pay higher wages and pay overtime when they don't come to get others to work so that they can produce. So there are cost related challenges that are significant, right, in the US. But we are now pushing very hard to get price increases to compensate for general inflation-related costs, right? And some of which are going to come, have been approved to come in the next quarter. So that's the situation in the U.S. So U.S. is not a demand problem, really.
Okay, thank you so much.
Not at all.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to Mr. Pradeep Tolia for his closing comments.
Yeah, thanks, Lizelle. On behalf of Systematics Institutional Equities, I would like to thank all the participants who logged into this conference call. Thanks to the management for answering all the questions. I would request Anand sir if he has any closing comments to make.
No, I just want to thank everybody for their engagement as evinced by the questions that they've asked, and also for their continuing support, and I think importantly patience as we have ridden through some of the most challenging phases in the history of this company, right? I just hope people are beginning to see some of the silver linings that are now evident, as the problems become more behind us rather than ahead of us, right? And start believing that this business is all set to start moving forward.
Right. Thank you so much, sir.
Thank you. Ladies and gentlemen, on behalf of Systematic Institutional Equities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.